Have you ever wondered who really controls the money in your wallet? Who decides whether your loan gets cheaper or more expensive? It's not just your bank manager, and it's not only the finance minister. The real mastermind behind India's money game is the Reserve Bank of India, the RBI. It's like the brain and backbone of our entire financial system. But what does it actually do? How does it balance growth, inflation, and the entire money flow in such a massive country? And why do people always talk about terms like CRR, SLR, repo rate, and reverse repo rate every time the RBI makes an announcement? Let's break it all down in the simplest possible way. Think of the RBI as India's financial traffic police. Too much traffic, there's chaos. Similarly, too much money flowing in the market means prices shoot up. That's called inflation, which eats into everyone's pocket. Too little money means people stop spending, businesses don't get loans, and jobs dry up. So RBI's biggest job is to strike the perfect balance. Enough money for growth, but not so much that inflation runs wild. But how does RBI do this balancing act? Imagine you deposit Rs 1,000 in your bank. Does the bank keep all your money locked in a safe? Not really. It lends most of that money to other people. That's how banks make money, through interest. But to ensure banks don't run out of cash during emergencies or financial shocks, RBI says, wait, you can't lend out everything. You must keep a certain percentage with us, the RBI, as a cash reserve. When the RBI wants to reduce the money supply in the market, say to control high inflation, it increases the CRR. This means banks have less money to lend, so people borrow less, and spending slows down. If RBI wants to boost lending, it can cut the CRR, so banks have more to give out as loans. Next comes SLR, the Statutory Liquidity Ratio. Think of SLR like a backup plan. Banks can't just hold cash reserves, they also need to invest some money in safe assets like gold or government bonds. So if the SLR is 18%, for every Rs 1,000 deposit, the bank must park Rs 180 in these safe, liquid assets. Let's talk about the big one, the repo rate. This is probably the most famous tool RBI uses and the one you hear about most often on the news. Simply put, repo rate is the rate at which RBI lends money to commercial banks. More people borrow, spend, and the economy grows. But if inflation is heating up too much, RBI hikes the repo rate. This makes borrowing more expensive for banks and for you too, so people borrow less and spending slows down. Sometimes banks have extra money lying around that they don't want to lend out to risky borrowers. So they park that surplus money with the RBI and earn interest on it. Why is this useful? Because it helps RBI absorb extra liquidity from the market. Well, RBI doesn't do this randomly. They analyze what's happening in the Indian economy and the world, oil prices, global markets, the dollar, food prices, and more. Think about it. A simple 0.5% change in the repo rate can change your EMI, your FD rates, and even your job prospects. Higher rates slow it all down. People borrow less, spend less, and the economy cools off. So these rates are not just random banking jargon. They literally decide how your monthly budget looks. In the end, the Reserve Bank of India is like the silent guardian of your money. It doesn't just print notes or check fake currency. It's constantly monitoring, tweaking, and balancing so that growth and inflation stay in check and your money doesn't lose value overnight. This is why it's called the banker's bank, because every bank must follow its rules. So next time you hear RBI has changed the repo rate or CRR has been increased, don't just skip that headline. Know that this tiny percentage shift can change your entire financial plan. If you understand how CRR, SLR, repo rate, and reverse repo rate work, you're already a step ahead in your money game. Because smart money management doesn't start at your local bank. It starts with knowing who really controls the flow. And now you know it's the RBI. So stay smart, stay informed, and remember, when you understand money, you control money.